friends, welcome back to the Finance Scribble. I make videos all about the financial aspects of life that I've learned along the way and would love to share them with you. Today, I am going to define some of the investment terms and lingos we hear all the time. I was confused at first and had to do a lot of research on my own, so hopefully this video helps you on your research journey. If you like videos like these, please subscribe and come back weekly for more. Kicking off with capital gains. These are the increase in value of your assets relative to the price you originally paid for them. I'll give you an example later. There are generally two kinds of capital gains, short-term and long-term. Short-term is when you hold on to the assets for 1 year or less. Long-term is over 1 year. They are taxed differently as well. Short-term is taxed as a person's ordinary income based on your filing status. Long-term capital gains is taxed at either 0, 15, or 20% based on your income and filing status as well. If you're single and make $40,400 or under, you pay 0% in capital gains tax. If you are married filing jointly and have an income over $80,801 but less than $501,601, you pay 15% capital gains tax. These are all 2023 numbers, so they may change in the future. Next is cost basis. You usually hear this and capital gains talked about together. This is the original value of an asset, usually the purchase price that you paid at the time of purchase. Now, putting those two terms together in an example, let's say I purchased 10 shares of Vanguard Total Stock Market Index Fund, VTI, today. Ignore the fact that today is a Saturday. Each share of VTI is $212.71. Your cost basis would be $212.71 times 10 equals $2,127.10. Now, I'm going to estimate that I'll sell all 10 shares in the year 2025. The total of the sale would be $3,875. To figure out my capital gains, I would subtract the cost basis from my total sales to get $1,747.90. As for my capital gains tax, this is considered long-term capital gains since I've had it for 2 years. Let's assume my income is above the $40,400 for single person, so my capital gains tax rate is 15%. This would mean my capital gains tax is $262.19. Then we have index funds. Index funds are funds that represent a theoretical segment of the market and are designed to follow a benchmark index like the S&P 500. They are a basket of stocks like the ones in this S&P 500. They are priced at the end of the day. As an example of index fund is the Fidelity Zero Total Market Index Fund. It more or less mimics the entire stock market. Very similar to index funds are ETFs or exchange-traded funds. They are also baskets of assets or stocks. They can be purchased throughout the day when the market is open, just like regular stocks. Some investors like ETFs better as they provide a little bit more flexibility since you can trade them during the market open. That is essentially the main difference between index funds and ETFs. Both great options, so you can't go wrong either way. An example of an ETF is the Vanguard Total Stock Market ETF. Next, we have expense ratios. This is a measure of how much a fund's assets are used for administrative and operating expenses. For us, our general rule is to buy index funds or ETFs with an expense ratio lower than 0.5%. Most of ours are actually way lower than that. I'll do a video in the future of what we hold in our investment portfolios if you think that might be interesting to see. As an example, you can see that in the Fidelity Zero Total Market Index Fund, the expense ratio is listed as 0%. This is one of Fidelity's newer funds where they have zero expense ratios. Dividends. They are distribution of corporate profit assets to qualified shareholders. This happens for index funds and ETFs as well. Target date funds. They are a class of mutual funds or ETFs that periodically rebalances assets to optimize risk and returns for a predetermined time frame. The asset allocation of a target date fund is typically designed to gradually shift to a more conservative profile so as to minimize risk when the target date approaches. It is a convenient option for investors who want a hands-off approach and let the fund go on autopilot. If you really don't know how or dislike the idea of managing your own investments, target date funds are a great way to set it and forget it. You typically would pick a target date or target year actually and get the fund for that year. For example, if I want to retire in 2055, I would pick a target date fund that matures in the year 2055. As the year gets closer, it will help me make the portfolio's asset allocation more conservative, so less stocks and more bonds. Speaking of asset allocation, this is an investment strategy that aims to balance risk and reward by dividing a portfolio's assets according to a person's goals, risk tolerance, and length of time to invest. For us, we have our allocation at 80% stocks and 20% bonds. A common rule that is thrown around out there is to take 100 or 110 since the life expectancy is growing and minus your age to get the percentage of stocks you could have in your portfolio. We didn't really stick to this rule as we feel like our risk tolerance is higher and will maintain at this level for a while even as we get older. That's a wrap for today. There's way more terms out there that isn't in this video, but this is a good start for beginners. Like, share, and subscribe, and come back weekly for new videos. Thanks for watching. Happy scribbling. Bye.